Hi guys. Today we will analyze Pfizer stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Pfizer was a good performer in the last year, but there are some doubts in the very recent evolution. The short-term trend is negative, but the long-term trend is still positive. Although the long-term is still positive, this may be a trend turning. Support levels are around $50 and $47. Strong support level is around $41. Resistance level is around $54. The next resistance level is around $57.50. In the last month the stock has been trading between $50 and $55 range. It is currently trading near the lows of this range. The stock has an average volume of 42 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average PE ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 15% per year, for last 5 years. We see that the average profit margin of the stock has been around 25% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 84% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Pfizer company: bad, average, and good. First scenario. Pfizer will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 20%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $46. The second scenario. Pfizer will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 23%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $65. The third scenario. Pfizer will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 26%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $89. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.9. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Pfizer, analysts forecast growth rate around 10% per year in next 5 years, and future PE around 8. Again, I will use 3 different scenarios for Pfizer company: bad, average, and good. First scenario. Pfizer will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future PE would be low, 12. In this case, the fair value of the stock today would be $20. Second scenario. Pfizer will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 14. In this case, the fair value of the stock today would be $28. Third scenario. Pfizer will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 16. In this case, the fair value of the stock today would be $38. As you can see, today the stock is overvalued, $50, even if we expect the company's high performance in future. The stock is not priced too expensively while it is growing strongly. Keep an eye on this one. I don't own this stock, but I have added it to my watch list. Company's strengths. Pfizer is a leading global developer and manufacturer of pharmaceuticals and biotech drugs. Its products include oncology and immunology drugs, treatments for rare diseases, and vaccines. The company is advancing its pipeline with assets that will contribute to future growth. It has a robust pipeline of biologics, and strong R&D capabilities. Pfizer is building on its vaccine success with the mRNA platform, and has initiated a phase 1 trial for an mRNA influenza vaccine for adults. It also plans to study mRNA-based vaccines for other respiratory viruses. Pfizer's return on assets of 10% and return on equity of 25% are amongst the best returns of the industry. Profit margin is 27%, this is amongst the best returns in the industry. The revenue is expected to grow by 10% on average over the next 5 years. Pfizer is expected to show a strong growth in earnings per share. In the coming 5 years, the EPS will grow by 20% yearly. Risks. Risks for Pfizer include the expiration of patents for key products, long product development cycles, and political and regulatory hurdles. By 2027, Pfizer will face patent expirations and loss of exclusivity for products with total peak revenue of about $17 billion. These include Prevnar, Eliquis, Xtandi, and Ibrance. Like other pharmaceutical companies, Pfizer faces risks related to reimbursement coverage for its drugs. Insurers in the U.S. and national health agencies in overseas markets may restrict or deny coverage for certain high-cost drugs, limiting access to these products. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.